Welcome to Oregon Cash Flow Pro. My name is James Barber and I'm here to help you maximize your cash flow. So a viewer had a question, a follow-up to my video on ATVs, whether to pay cash or finance. You can find that video right here. And he asks, why did you choose a bank over your policy? I know that the finance is slightly less interest rate on paper, but technically wouldn't a loan against your policy yield less out-of-pocket expenses with no loss of opportunity cost? Thanks for your time.
Oregon Cash Flow Pro offers free money management advice to help you take control of your finances. And now here's your host, personal finance enthusiast and licensed insurance broker, James Barber.
So first, I want to direct you to check out this video that I made where I expose some of the myths around policy loans. And that kind of gets to the heart of why I chose the bank over my policy in this instance. So when I do my calculations, I don't see less out-of-pocket costs if I use my policy as opposed to using the bank's loan. One, there's no loan fee added into the cost of using the bank loan. So that's a wash there. It doesn't cost me anything to use the policy loan either. One of the things I'll note too, in that video where I mentioned I was about to pay cash for my ATV, I don't actually hold much cash. Everything that I've got is in my policy. So when I talk about using cash personally, I'm talking about using cash that I have sitting in my policies that's actually growing and working for me, because I'm all about maximizing that cash flow. So I'm not here just suggesting you do it. I'm doing it personally, practicing what I preach. So I also utilize a HELOC, and I use that in conjunction with my policy in order to move cash as efficiently as possible. So when I want to get money out of my policy, it's going to take a couple of days. I can have it direct deposited right into my account, but it does take about 2 days in order for that to happen. With my HELOC, I can transfer money instantly. I just get on my computer, punch a few numbers, and the cash is available. So I utilize those two things simultaneously. If I know I'm going to pay cash on something, I actually just transfer the money from my HELOC into my checking account, and I use my debit card or a checkbook, or I pull out cash. And then I reach for a withdrawal from my policy, and the withdrawal from my policy ends up going back into the HELOC as soon as it gets into my account. So I basically only pay a very slight bit of interest on that money while it's out of the HELOC. Make sense? I just wanted to clarify how I use when anytime I say I'm using cash or I'm thinking about using cash, I'm referring to money out of my personal policy. When I'm talking about it in a broader sense, and I'm speaking to you, the viewers, I'm assuming a lot of you viewers out there do actually carry cash. So when I do some comparisons, I will do comparisons when it comes to holding cash in your checking account or savings account, and then compare that to whatever we're talking about in that video. So I don't quite understand where this viewer is coming from, where they think that the overall out-of-pocket expense is lower if I use my policy as opposed to going through a bank, unless he's assuming that there is some type of a loan fee tacked on. In this case, there was no loan fee added on to it. And the way that he phrases that question, it makes it sound like there's some opportunity cost by going with the bank. And I actually think, so when I weigh these two loans against each other, I think I create more opportunity and I diminish the opportunity cost when I use the bank loan in this instance. So if we want to go straight interest expenses, I definitely save if I have with the loan that I got on the ATV. So if I were to use cash, pulling money out of my policy, I'm going to borrow that at 6%. And I'm going to get credited in my policy at 6%. So it's basically a wash, which is great. I like how that works. In this case, I have the opportunity to borrow at 4.49%, and I get to leave that money in my policy growing at the potential dividend rate, which currently is at 5.65%. So in this instance, I'm using a little bit of arbitrage by going with the lower interest rate from the bank. As long as those costs are not offset by any loan fees, dollar to dollar, I'm better off in the bank. Now, opportunity cost. So if I borrow against my policy to buy the ATV, I would be getting a loan from the insurance company for $8,000, and the insurance company will use as collateral $8,000 in my policy. So what shows as cash value in my policy goes down by $8,000. I end up getting credited with that wash rate of 6%, but I'm paying 6%. And what I end up with at the end of the day is I have a paid off ATV. So I have an ATV with $8,000, probably less because I just drove it off the lot, but theoretically about $8,000 in equity sitting in an ATV. I no longer have that equity in my policy until I pay that loan back. Now the equity in the ATV, what is that doing for me? It's not doing really anything for me, except if for some reason I get into financial trouble, they're not gonna be able to take my ATV away from me, okay? On the flip side, if I go to the bank and I say, bank, I'm about to have $8,000 in equity in this ATV, would you use that as collateral and give me $8,000? And then I use that $8,000 to buy the ATV. Now the situation I'm in is I have an ATV, I still have $8,000 in my policy, that's still liquid, and I don't have any equity in the ATV. So right now I have $8,000 that's liquid. That is opportunity. I can do a lot with that. I can pay off the ATV if I wanted to. I can use it for a different investment if I wanted to. I have a lot more control over that $8,000 when it's sitting in my policy than I do when that $8,000 is sitting in equity in the ATV. So that's kind of the key to this whole thing is, and I think it's where a lot of people get a little bit confused about this infinite banking concept, because it's not really talked about in this way. In fact, I think a lot of people deliberately talk about it in a different way and try and lead you into thinking that you're better off using your policy loan. And like I say in that video where I expose the loans, they're not magic, okay? A loan is a loan. You do get some extra benefits from it. But when we look at this situation, I'm in a much better financial situation when I've used the bank's money to get the lower interest rate and I still have that money in my policy. It's all about control. And one of the things, even in Nelson Nash's book, he talks a lot about control. And if you get the bank out of the equation, you have control. Well, I don't think you have to get the bank out of the equation for you to be in control. As long as you have enough liquid funds that you can get the bank out of it if you want to. So I didn't lose any control by having the bank liquefy that equity that would have been in the ATV. I actually gained control because now I still have that money growing in my policy at a higher rate than I borrowed, and I can still do whatever I want with that. Hopefully that clarifies things. If you have any questions about that, put them in the comment section below or email me. I love getting questions from you guys. I want to start doing something like this regularly. So if you have any burning questions, send them to me any way that you can, and I will try and get them up in a video. And I also try to respond to your question in whatever medium you sent the question as well. So it's really easy for you to find. So if you found value in today's video, hit the like button, subscribe. Let's continue along this financial journey together. And while you're here, check out these other videos. We'll see you next time. Now go maximize your cash flow.